Good afternoon, guys. Andrew Schartenberg, your friendly neighborhood mortgage engineer here for your daily rate report. Today is Tuesday, January 4th, second day of the new year. Getting right into it today, rates have actually decreased a little bit. This is due to some strength in bond pricing over the last couple of days, and today we've got conventional rates, meaning Fannie Mae, Freddie Mac, fixed rate mortgages, very vanilla loan scenarios, excellent credit, down payment, etc. We've got rates for unconventional loans, 30-year fixed of 4.75, so those are down about an 8. And on FHA and VA government loans, you're going to be looking at about 4.5. So those are down a little bit as well. To see some significant decrease, again, I kind of hold that we're going to be seeing it later in the month, if at all. And the rest of the week, we really have a light trading week in the bond market due to not very much economic data coming out. We do have the employment report coming out Friday, so that could be the biggest change of the week. This afternoon, we do have the Fed minutes coming out, so that could change stuff if different from what the analysts are estimating. So those are rates for today. What I wanted to talk about for the home buyer tip of the day is your credit report. There's a lot of myths related to credit. It's probably one of the biggest things that I talk to my clients about and include them into when we're going through a mortgage pre-qualification. So I wanted to give you a couple helpful tips, and we'll get into it. The biggest thing, obviously, it's pretty logical, is don't be more than 30 days late on any payments that you may have. What I mean here is any credit cards, any student loans, mortgages, car payments, stuff that shows up on your credit report, charge accounts at stores, lines of credit. A lot of those things will have payment dates that they're due, such as the middle of the month. But as long as you don't go 30 days past that due date, you'll never be reported late to the credit bureau. So just because you missed a credit card payment by a day doesn't mean that they can report you to the credit bureau. They can jack up your rate and your fees, but they can't actually report you. So that's the first thing. Secondly, on your revolving debt, that is lines of credit, credit cards, and charge accounts. You don't really want to go over 35% of the credit limit on any individual account. Once you start going over 35%, that's when you will be dinged on your credit score for it, and the higher you go, the harder it'll hit you. So as you max stuff out, or if you go over the limit, you'll certainly see a decrease in your credit score, and that can happen pretty quickly. The nice thing to know about that is that as soon as you pay it off, your score will go right back to where it was. So it's not the end of the world, but you certainly don't want to be running up your debt. You also don't want to close out old credit accounts. There may be accounts that you've had for the last 10 years and you just don't use them anymore. So a lot of people will advise you to close those, and I'm not an advocate of leaving a ton of available credit if you can't manage your finances very well and you're going to be tempted to use it. But all of the things being equal, it's better to leave older accounts open and occasionally use them and pay them off, because those accounts have a lot of history on them and they're going to factor in more heavily in the credit reporting models than the new accounts that you may open. And also in relationship to that, you don't want to open many new accounts at one time, because that can hurt your credit score as well. Finally, and this is the biggest myth that a lot of people have, is that even looking at your credit score hurts it, and that's really not true. Where it can be true is if you look for many different kinds of credit in a short period of time. So if you come to me looking for a mortgage, and you also go look for a car and a new credit card, and open up an account at Home Depot or at a furniture store all at the same time in anticipation of your home purchase, that looks like you're trying to overextend yourself to the credit bureau models, and your score can decrease. So it doesn't necessarily hurt to go shop for a mortgage with 1, 2, or 3 people in a 30-day period, or even open a credit card and then look for a mortgage a month or 2 later. You just can't go overboard with it. And keep in mind that the less established your credit is, the more that going overboard will affect you. So if you've had, been a user of credit for many years and you have a number of accounts, then shopping for 1 or 2 things isn't going to kill you. If you are going to look at your credit, though, talk to a mortgage professional. Especially, I know that you guys are, most of you out there, interested in purchasing a home or refinancing a home. So it's a good idea to go to a mortgage professional, because if there's stuff on there that needs to be disputed, if there's errors, we tend to, obviously we do this on a daily basis, so we can certainly help you, and most of us will do that for free as a courtesy to potential clients, past clients, family and friends. If you don't want to do that, you can go to annualcreditreport.com. Again, annualcreditreport.com. That's the site that's sponsored by the three main credit bureaus, Equifax, TransUnion, and Experian, and you can get a copy of the report there. Lastly, if you want to use a monitoring service, if you're very concerned about your credit, those usually run you about $14, $15 a month. You can always go to that one that they advertise on TV a lot, freecreditreport.com, and sign up for a monitoring service, and that won't hurt your credit either, and it certainly can't hurt. Okay, that's it for today. Again, you can always reach me at andrew@otfunding.com. Again, andrew@otfunding.com if you ever have questions about mortgages. Thanks, and I look forward to talking to you guys tomorrow.